Welcome everybody, I hope you're all having an excellent day. Today we will explore the 3-block system, which is the strategy we used in the Black Swan Index Fund in order to analyze the stocks and know if we will buy them or not. Without further ado, let's go. The 3-block system is a strategy based on fundamental analysis in order to evaluate the stocks using non-Gaussian models, as well as utilizing the principle of randomness and escaping different trading fallacies. What? Let's start by discussing what is fundamental analysis. Fundamental analysis is a method that we use in finance in order to find the intrinsic value of a security. Let's imagine we have this graph here, whereas in our left we'll have US dollars and on the bottom we'll have time, let's say in days. Any graph that we would have is going to fluctuate. It's going to go up, down, different ways of movement. Using fundamental analysis, we can determine what is the price that we believe is the real price of the stock. That means that every time it is above what we determine to be the intrinsic value, it will be overpriced. Whereas every time that it is under, it will be underpriced. We determine the intrinsic value by different ways, but mainly it is doing research on the stock, on its financial statements and all the notes that include it. Therefore, it is not a process that takes a short amount of time. We do this analysis on the 3rd block of the 3-block system. Since we're talking about fundamental analysis, it is important as well to mention what technical analysis is. At the end, both of them are different methods that want you to make some money. Technical analysis assumes that the intrinsic value is already reflected on the stock price. Therefore, there is no need to try to find the intrinsic value by reading the financial statements, since what matters is the chart itself. It uses different indicators, such as price trends, moving average, oscillators, chart patterns, support and resistance levels, and volume and momentum indicators. Based on this, it tries to find opportunities to buy or sell a security depending on the historical data. It's important to clear out that what we just said about fundamental analysis and technical analysis is a very brief notion that we want to give you. We will make in the future a video regarding fundamental and technical analysis if that is needed. Now that we understand what fundamental analysis is, we can start moving forward and seeing what are Gaussian financial models and non-Gaussian financial models and why we prefer one over the other. Let's imagine that we are in the metro system of any city. New York, Shanghai, Caracas, whatever you prefer, it really doesn't matter. Right at this moment, there are 100,000 people riding different trains in the whole system. We have to think what's going to be their average height. I believe their height is going to be 170 centimeters. Why? Because that's the average in the world. Give or take, could be 180, 150, doesn't matter, work with me. Then the tallest person in the world, called Sultan Qasim, which has a height of 251 centimeters, join one of the trains. Now we'll have 100,001 extra person. What is going to be the new average height? Well, you guessed it, it's going to be exactly the same. It is 170 centimeters, because even though we have the tallest person in the world, it does not affect such a big sample of 100,000 people. Therefore, the change is less than 1%. Now, let's make the exact same example, but we're going to use our assets. We have the same 100,000 people in the trains of the metro, and we will have to guess the average assets, such as cash, stocks, properties, and so on. And we will guess that we have about $50,000 per person in average. And then this guy comes in. For those that do not know who he is, he owns a very small company, something maybe you heard before, called Amazon. I think they're on the rise. His name is Jeff Bezos, and by the time this video is being made, he has $192 billion in assets. That number comes from Forbes' real-time billionaire list. If he joins the metro because he's visiting the city, I don't know what reason he has. He just joined the metro with us, alright, the system. What would be now the new asset average of all of us? Well, you guessed right. It is $192 billion. The change is more than 99%. That is insane. But what it means as well is that those 100,000 points of data where you and I were included do not matter anymore. This is because applying normal distribution in the financial system do not make sense. Just one point of data can overtake any other point of data you had seen before. And that's what brings us to the bell curve. Don't be afraid, this is not a statistical class nor a mathematical class, but it's very important that we understand this if we want to make the correct investments. Based on our example, our average was 170 centimeters. If we calculate a sigma or a standard deviation of, for example, 10 centimeters, that would mean that one sigma to the left left and 1 sigma to the right, which means from 160 centimeters to 180 centimeters, we would have 68.2% of the whole sample. If we move 2 standard deviations or 2 sigmas to the left or 2 to the right, then we would have 95.4% of the sample between 150 centimeters and 190. And by moving 3 sigmas away, we would have between 140 centimeters and 200 centimeters, we would have 99.7%. This of course makes sense. It's going to be extremely hard to see someone that is going to be below 130 centimeters or above 2 meters. It's not impossible, it's just very unlikely. But when we try to apply this into the financial market, it makes zero sense. For example, the probabilities that the crash of 1987 would have happened was 25 sigmas away. That is a probability that another meteorite like the one that killed the dinosaurs would happen tomorrow. Therefore, applying normal distribution into the financial market, it's just outrageously inaccurate. Based on normal distribution, it would have been impossible for Jeff Bezos to join the train with all of us when we were riding. There are different components and different theories in the normal distribution. We have standard deviation, Sharpe ratios, beta, Black-Scholes pricing model, modern portfolio theory, CAPM, and all of these try to find the accurate price of a stock using Gaussian models and using normal distribution. We're not saying that they are completely inefficient, but we're saying that they are wrong since they do not consider randomness. Therefore, we do not use them in the 3-block system. On the other hand, non-normal distribution is divided in different theorems than those of normal distribution. For example, we have power laws, we have Pareto distribution, fractal laws, Schiff law, Monte Carlo simulations, and principle of randomness. And what we do is we obtain the qualitative data from our fundamental analysis, then we input that data utilizing the non-normal distributions, and then we can estimate the price of the asset. And is this complicated? Yes. Does it take time? Yes. This is the same as if you were, for example, trying to lose weight. You will have to know about macronutrients, eat healthy, find a workout routine, be realistic, be consistent, and have time. It is the exact same thing when we're investing. If you want something that takes you to the moon and you're gonna make 500% in a week, this is not the place, and again, this is not the video for you. But if what you want is to learn a consistent way in order to analyze the stocks, then we can continue. One principle that we use in the 3-block system constantly is the principle of randomness, and in order to understand it, we do have to follow a lot of theory that is being written on it. In the paper Mild versus Wild Randomness, Benoit Mandelbrot and Nassim Nicholas Taleb defines in only 9 pages what is the main difference between normal distribution and non-normal distribution when analyzing the stock market. These 2 types of randomness are very easy to understand. Mild randomness is unpredictable, but we can quantify it. For example, a coin toss. The probability of heads or tails is 50-50, even though we do not know if we will get head or we will get tail. Whereas wild randomness is the randomness that we cannot control, is the one that we even do not know until it happens, such as the financial crisis of 2008 and many other examples. It is extremely important to understand the principle of randomness because thanks to it we can keep calm and actually earn some money in the stock market, because we will know that the decisions that we made were the correct decisions, even though we know that not every correct decision will give you a good outcome, same as bad decisions won't always yield a bad outcome. Nevertheless, most likely than not, good decisions bring good outcomes and bad decisions bring bad outcomes. As said, there is a lot of theory regarding the principle of randomness, and I recommend you to read any of these books that we have here, from those written by Benoit Mandelbrot or those by Nassim Nicholas Taleb, even Burton Malcolm, or Nobel Prize winner Daniel Kahneman with the book Thinking Fast and Slow. All of this theory will give you a different perception on how to analyze the stock market that does not require a standard deviation. The last part of the 3-block system that we have to see is escaping trading fallacies. Trading fallacies are false assumptions. They sound reasonable but are in fact flawed. I'm gonna give you an example. Let's say there is a boat and the boat has 100 people inside. Unfortunately, the boat sinks and only 20 of them survive. A reporter, very cute one as you can see, finds those 20 survivors and it asks them, what did you do to survive? All of them answer different things, but they have one trait in common. They all prayed. Therefore, this journalist goes and make a paper and says, those that prayed are saved by God. Nevertheless, you ask yourself, what about those that prayed and did not make it? This is the graveyard fallacy, or the survivorship bias, which means that we tend to hear those that succeed and not those that fail, and we come to the wrong conclusion. I'll give you another example. Same reporter, but this time she's going around to see those successful entrepreneurs. What makes you a successful entrepreneur? They reply different things, but they have something in common. They all say that a successful entrepreneur needs to be a hard worker, needs to be confident, needs to be a risk taker, and needs to think different. Therefore, she goes to her blog and writes 4 traits to be a successful entrepreneur. Then just stop for a second and think, what about entrepreneurs with those 4 traits that failed and did not become successful? In total, we had analyzed over 40 fallacies. This gives us an advantage in comparison to other people that is investing, since we acknowledge where we're taking rational decisions and when we're not. We have a series about the fallacies both in our Patreon and in our YouTube channel, so we can discuss them in detail. Wrapping up, we can see that the 3-block system is not a fast-making money strategy. On the contrary, it is a slow process in order to analyze a stock where taking a decision might take weeks or even months. If you want to know more about the 3-block system, you can join our playlist where we explain all of the fundamental concepts of each of the blocks. Or if you already know those fundamental information, then you can come and join our playlist where we analyze all the different stocks on a daily basis, either on our Patreon or on our YouTube channel. If you want us to analyze a stock, please don't forget to write it in the comments and we will do our best to analyze it. Thank you very much and see you in the next video.